We will have a very interactive panel after the break that will discuss different topics concerning taxation. And to open this discussion and to give a bit of input that we have gathered, in fact, on the basis of the information we got from our member organizations, I just wanted to talk a bit about this project we have conducted, that we wanted to look a bit at taxation, especially on the possible and existing wrappers such as ISK in Sweden, and see if they exist and if the member organization find them actually profitable to investors. Because Sweden, for quite a bit of time already, has been portrayed as this main model here in Europe, where many people invest, where ISK has sparked a discussion on a daily basis among retail investors who discuss their investments, who talk about where and how they are investing. So this has become an everyday discussion topic that is not the case in most of the EU member states. And in fact, in contrast to that, we have countries like Ireland or Poland, when many citizens are not even aware or not sure exactly what shares or stocks are. And they don't invest, and quite often they don't also, from what they say, don't intend to start investing. And at the European policy level, the discussion on retail investment participation in the recent months have frequently placed taxation at the center of the debate. And of course, taxation matters. So it shapes incentives, it affects relative product attractiveness, and interacts with product design, distribution models, and financial capability and households' preferences. So all those factors influence how savings are channeled through investments, or whether they are not channeled, in fact, into investments. However, the findings of the report and the discussion that we had with member organizations suggest that taxation alone is not really the crucial factor, neither does it really explain differences in retail investor participation across Europe. So in several jurisdictions, administrative simplicity appears to be at least as important as the level of the tax advantage itself. And in fact, Sweden is a good example because we have the investment and saving account, and it benefits from a favorable tax regime. But stakeholders repeatedly emphasize that its success and equally, if not more, is attributable to simplicity. And there have been already several quite well-attended conferences in Brussels, where the Swedish model was presented and discussed. And in fact, even the very young Swedish investor were underlining that for them, the tax incentive was not that important. What really mattered for them and why they did start investing was in fact the simplicity and the fact that they were not burdened with many of the other things that the retail investors in other member states have to deal with. So taxation seems to be an important amplifier of a good product design, I would say. And the report that we are drafting and finalizing right now compares standard brokerage accounts and dedicated savings and investment account structures across several European jurisdictions. So for the time being, we have included 7 countries: Sweden, Germany, France, the United Kingdom, the Netherlands, Estonia, and Iceland. From that, I would say that based on the questionnaire and the interviews that we have conducted, we were examining 3 interconnected dimensions of tax policy. So the neutrality and product bias, the administrative friction, and the inflation or real return distortion. So we have compared and identified distinct national approaches. Each was characterized by its own strengths, limitations, and trade-offs. So we have included all those countries, and maybe I will not go into detail because I'm also looking at the time and we're a bit behind the schedule. But what was quite important for us to discover was in fact the situation in the Netherlands, when the system taxes expected returns regardless of the actual outcome. And of course, this can disadvantage low yield investments, volatile assets in bad years, and leverage or high risk strategies if returns are below the assumed return. So the organization that is representing the retail investors in the Netherlands was quite critical of this system, and I understand that they also are in the conversation with the government and the policymakers in the Netherlands to try to change it. The next slide. So actually, what the members and members organization have flagged as retail friendly. So when we talk about the Sweden's ISK, the things that were underlined is this no-cost basis tracking, no transaction records, and also the interview suggested that this mattered really more than the tax break itself. When it comes to Estonia, so there is one container for nearly all types of assets. There is this indefinite deferral, and in fact, it's the only country, at least from all the ones that we have interviewed, that has an indefinite deferral, and also the ability to receive dividends gross for full reinvestments. We have also the UK ISA with very generous tax incentive, but again, it seems not to be enough to attract wider participation of retail investors. And the deferral system, it has been singled out in Estonia especially, and there are apparently some other European countries that do have some sort of deferral system, like Poland, I understand as well, recently, and it's also been a quite important component of positive assessment. Next slide, please. So there is the thing that our members also quite often underlined in the interviews was the fact that there is no comprehensive inflation adjustment, and this is true for all the countries that we have interviewed. So in fact, all the countries that were included and are included in our report do tax nominal returns. So there is no adjustment whatsoever to cap the effect of inflation. The previous speaker has also been talking about this. Next one, please. So as I mentioned already, the Netherlands, we would say, is on the very negative side of the spectrum of how the situation of retail investors looks like. And what was underlined in the interview was, in fact, that the system that is placed there can really disadvantage investors whose actual return are lower than this assumed returns, and that the organization is trying to push for changes that would have the situation changed. The next one is Iceland, but I would then not go too much into detail because we had just quite comprehensive presentation on Iceland. Then the UK. And as I said already, so the system there is also quite often put next to the ISK in terms of how favorable it is to the retail investors. But the thing is that, in fact, there has been not such a wide uptake as the attractiveness of the ISA could have suggested. And what we have also understood from the interview with our UK members is that there is really no certainty that the system will actually shift savings towards stocks and shares as it is intended. So also for the UK government to think what other changes could be made to the system to encourage more wide participation. Germany, next. So in fact, in Germany, for the time being, there is no tax incentivized wrapper, and the state support reserved for pension products and life insurance does. And there is the annual 1,000 return allowance, which our member organization does consider as way too low to matter. And in fact, the household investment in shares and other securities remains in the most wealthy individuals in Germany. And there is a very little mobilization of savings, as you can see, over 37% still sits in currency and deposits. We have then France, and in France you have equity savings plan, so plan d'épargne en action, sorry for my pronunciation. And so it is a tax advantage investment account that allows French residents to invest in eligible European shares and certain funds. But as we understand, its popularity is undercut by the low profitability for providers. So it's not really widely promoted. And outside of the PEA and 2018 reform removed relief for long-term holdings. So this was also cited as one of the reasons for regression that actually punishes long-term investing. And the last one, so Sweden. As I already said, quite often at the policy level in the debates in Brussels, Sweden is promoted as this one model that should be taken on by member states who are currently considering introducing some wrappers. And in fact, as I understood, Poland has gone the Swedish way, and the upcoming Polish ISK is going to be very much modeled on the one from Sweden. But our member organization has also had some concerns about the current model, and in fact, it criticized the ISK that for levying tax annually on a standardized portfolio value. So the ISK, as I said, it combines the exceptional simplicity, but there is also a trade-off. So the tax might arise even in weak or negative return years, and there are individual losses that are not recognized. And also there you have no adjustment made for inflation. So the core takeaways from the interviews that we have conducted and the research is that the tax design, what it should definitely achieve is to curb distortions rather than create new ones. It should combine tax incentive, simplicity, and neutrality. So all those three angles are extremely important for individual investors. Simplicity should be a form of retail investor protection, in fact. And it would be really good if member states that are currently trying to employ some of those investment saving accounts, that they should also look beyond the headline rate. So tax timing, loss treatment, reporting, and competing products are also the features that really matter for retail investors. So I think it was a very short introduction to the panel that is going to unfold after a short break. And I would invite also everybody who did participate in the interviews with the Better Finance team to also, during maybe the panel, ask questions and also build on your national perspective and the evidence from your national jurisdictions to make the panel interactive, if I may encourage you to do so. Thank you so much.